Charlie Munger knew a man with an IQ of 160 who died broke, not poor in the struggling sense. Broke in the humiliating sense. A man with a PhD in economics who understood compound interest better than most finance professors, yet somehow managed to reach age 70 with almost nothing in the bank. This wasn't an isolated case. Throughout his 99 years, Munger watched a pattern repeat itself over and over: brilliant people making terrible financial decisions. Doctors earning $500,000 a year with negative net worth. Lawyers who could argue complex cases but couldn't balance their own checkbooks. Engineers who could design suspension bridges but couldn't build a simple retirement portfolio. The pattern was so consistent that Munger eventually concluded it wasn't a coincidence. Intelligence, he realized, doesn't protect you from financial stupidity. In many cases, it makes you more vulnerable to it. Smart people stay broke for reasons that have nothing to do with their intelligence and everything to do with how they think about money. This is the story of why brilliance and wealth don't correlate the way you'd expect. And more importantly, it's about the specific mental traps that catch intelligent people and keep them poor despite their capabilities. Because if you're smart enough to understand the problem, you're smart enough to avoid it. But first you have to recognize that being smart might actually be part of the problem. Munger believed that understanding why smart people fail financially is more valuable than studying how rich people succeed. Success can come from luck, timing, or factors outside your control, but failure, especially repeated, predictable failure, that's almost always self-inflicted. And if you can identify the patterns, you can avoid becoming another cautionary tale of wasted potential. The first reason smart people stay broke is overconfidence. And this isn't the obvious kind of overconfidence where someone thinks they're invincible. It's more subtle and more dangerous. It's the belief that because you're intelligent in one domain, you'll be intelligent in all domains. Munger saw this constantly. A surgeon who was brilliant in the operating room would assume he could pick stocks with the same skill. A software engineer who could write elegant code would convince himself he understood real estate investing after reading a few books. An academic who'd mastered quantum physics would think the stock market was simple by comparison. The problem is that intelligence is domain-specific. Being smart at medicine doesn't make you smart at investing. Being good at engineering doesn't make you good at business. But intelligent people often don't realize this because they've spent their whole lives being the smartest person in the room. They're used to figuring things out quickly, mastering complex subjects, being right more often than wrong, so when they approach money, they bring that same confidence. They think, I have an advanced degree, I understand mathematics, how hard could investing be? And that's when they make catastrophic mistakes that someone with less education and more humility would avoid. Munger watched a colleague, a brilliant lawyer, lose hundreds of thousands in the late 1990s tech bubble. The man had convinced himself he understood technology investing because he was good at legal analysis. He'd read articles, followed the trends, convinced himself he saw something others didn't. He was smart enough to build a complex thesis about why certain companies would dominate the future. He was also smart enough to ignore every warning sign, dismiss every skeptic, and rationalize every doubt. When people questioned his investments, he'd explain with eloquence and data why they were wrong. He sounded smart, he felt smart, and he lost everything anyway because intelligence doesn't save you from being wrong, it just makes you better at justifying your mistakes. The truly intelligent move, Munger believed, would have been to admit ignorance. To say, I don't understand this well enough to bet serious money on it. But smart people hate admitting ignorance. They've built their entire identity on knowing things, understanding things, figuring things out. Saying, I don't know, feels like failure. So instead they do what smart people do. They study, they read books, attend seminars, consume information. And this makes the problem worse because now they think they understand. They've confused information with wisdom, knowledge with judgment. They know a lot about investing, dates, names, concepts, theories. What they don't have is the hard-won experience that teaches you when to sit still and do nothing. Munger's rule was simple. The more you know, the more you should doubt yourself. Intelligence should breed humility, not confidence. But most smart people get this backwards. They accumulate knowledge and mistake it for competence. The second trap that catches smart people is what Munger called complexity bias. Smart people love complexity. They're drawn to it. Simple solutions feel beneath them, too obvious, not worthy of their intellect. When a smart person looks at investing, they don't want to hear, buy index funds and wait 30 years. That's boring. That doesn't require their brain power. Where's the challenge? Where's the intellectual stimulation? So they go looking for something more sophisticated. They discover options trading, complicated tax strategies, international arbitrage opportunities, cryptocurrency algorithms, private equity structures. Each one more complex than the last, each one making them feel smarter than the average investor who just buys boring stocks. Munger watched this happen in every generation. In the 1960s, smart people were obsessed with conglomerates and complex corporate structures. In the 1980s, it was junk bonds and leveraged buyouts. In the 2000s, mortgage-backed securities and derivatives. Every era had its version of complexity that smart people convinced themselves they uniquely understood, and every time the complexity destroyed them. Not because the concepts were flawed in theory, many of them were mathematically sound, but because complexity creates more ways to be wrong. The more moving parts in your strategy, the more things that can break, and when things break in a complex system, they break catastrophically. A Dr. Munger knew spent years developing an elaborate day trading system. The man had spreadsheets, algorithms, back-tested data. He could explain his methodology in exhaustive detail. It sounded impressive. It looked sophisticated, and over 5 years, it underperformed a simple index fund by 40%. He couldn't accept this. His intelligence wouldn't let him. So he concluded that he needed more data, better algorithms, more sophisticated tools. He kept adding complexity, convinced that the next layer would be the one that finally worked. He never considered that maybe the problem was the complexity itself. Munger's approach was the opposite. He looked for the simplest possible solution that could work. Not because he wasn't smart enough to understand complexity, he certainly was, but because he was smart enough to know that simplicity is harder to screw up. Warren Buffett and Munger built Berkshire Hathaway on simple principles. Buy good businesses at fair prices. Hold them forever. Don't do anything fancy. Wall Street thought they were unsophisticated. Business school professors thought their methods were too simplistic for serious academic study. Meanwhile, they became two of the richest men in the world by refusing to be clever. Smart people struggle with this. Simplicity feels like giving up, like admitting they can't handle the advanced stuff. But the truth is more brutal. The advanced stuff is usually just a way to lose money with style. And Munger had no interest in losing money, stylishly or otherwise. The third trap is analysis paralysis. And this one is particularly insidious for intelligent people. Smart people love to analyze. They gather data, study trends, read research, build models. Analysis feels productive. It feels like progress. But often, it's just procrastination dressed up as diligence. Munger observed that many smart people spend so much time analyzing opportunities that they miss them entirely. They want perfect information before making a decision. They want to understand every variable, account for every risk, model every scenario, and while they're doing all this analysis, the opportunity disappears. He saw this with real estate constantly. Smart people would spend months analyzing a property. They'd study comparable sales, calculate cash-on-cash returns, project appreciation rates, model different scenarios. Meanwhile, someone less intelligent but more decisive would buy the property, and 10 years later it would be worth triple. The smart person would then analyze why they missed the opportunity. They'd build spreadsheets showing what they should have done. They'd identify the exact moment they should have acted. And then they'd do the same thing again with the next opportunity, because the problem wasn't their analysis, it was that they analyzed instead of acting. There's a deeper issue here that Munger recognized. Smart people often use analysis as a defense mechanism against risk. If you're always gathering more information, you never have to make a decision. And if you never make a decision, you can never be proven wrong. Your intelligence remains intact, unbruised by reality. But the cost of never being wrong is never being right either. While you're protecting your ego with endless analysis, opportunities compound for people who were willing to act on incomplete information. Munger told a story about two colleagues considering the same investment in the 1960s. Both were smart. Both did their research. One spent 6 months building a comprehensive analysis. The other spent 2 weeks, concluded it was probably good enough, and invested. 40 years later, the second man's investment had turned into millions. The first man was still perfecting his analysis methodology. The irony is that the first man probably had better analysis. He understood the investment more deeply, saw more risks, anticipated more scenarios, but he understood it so well that he could always find a reason not to act. There was always one more thing to check, one more variable to model, one more expert to consult. This is why Munger believed that good enough information acted upon beats perfect information that paralyzes you. Smart people often don't believe this because it sounds anti-intellectual. Surely more information is always better. Surely deeper analysis leads to better decisions. In theory, yes. In practice, no. Because the real world doesn't wait for your analysis to be complete. Markets move. Prices change. Opportunities vanish. And while you're trying to achieve certainty in an uncertain world, someone else is getting rich with an 80% understanding and 100% commitment. Munger's rule was simple: if you understand the basics and the risk is acceptable, you can always learn more after you've taken the position. But if you wait until you're certain, you'll wait forever, because certainty doesn't exist in investing or in life. The fourth reason smart people stay broke is the status game, and this might be the most painful to acknowledge. Smart people, more than almost anyone else, need external validation. They've spent their entire lives being rewarded for their intelligence. Gold stars, good grades, prestigious universities, impressive job titles. Their entire identity is wrapped up in being recognized as smart, and that creates a financial trap that's almost impossible to escape. Because demonstrating intelligence costs money, a lot of money. Munger watched this destroy countless brilliant people. They'd go to expensive schools because prestige mattered. They'd take jobs with impressive titles over jobs with better pay because the status mattered. They'd live in expensive neighborhoods because being around other successful people mattered. They'd buy luxury cars because you can't show up to a partner meeting in a Honda Civic. At least, that's what they told themselves. Every decision was optimized for status, not wealth, and the two are often opposites. Status is about signaling to others. Wealth is about actual resources you control. You can look high status and be broke. You can look ordinary and be wealthy, but you usually can't do both because one requires spending and the other requires saving. A professor Munger knew epitomized this trap. The man had a PhD from Harvard, taught at a prestigious university, published widely in his field. Everyone in academic circles knew his name. He was invited to conferences, quoted in papers, respected by his peers. By every measure of academic status, he'd succeeded. He was also basically broke at age 60. His prestigious university paid him well by academic standards, but not enough to support his prestigious lifestyle. The nice house near campus that other professors could see. The European vacations, because that's where intellectual people traveled. The expensive dinners, because you can't invite colleagues over and serve cheap wine. He'd spent his entire career earning status and spending money to maintain it. And now, approaching retirement, he had nothing but his reputation. His status couldn't pay his bills. His prestigious connections couldn't fund his retirement. He'd traded financial security for the approval of people who, it turned out, didn't actually care about him once he was no longer useful professionally. Munger believed this was a particularly cruel trap for intelligent people because they're more susceptible to peer pressure than they want to admit. They tell themselves they don't care what people think, but their spending patterns reveal the truth. They care deeply. They need the validation that comes from being seen as successful. And here's the really insidious part. The smarter you are, the more expensive your peer group is. If you're a doctor, your friends are doctors. If you're a lawyer, your friends are lawyers. If you're an executive, your colleagues are executives. And keeping up with high-earning people requires high spending. You can't be the partner who shows up in the cheap suit. You can't be the doctor who doesn't belong to the country club. You can't be the executive who doesn't take luxury vacations. Or you can, but then you're not really part of the group. You're the weird one, the cheap one, the one people talk about with a mixture of pity and confusion. So smart people make a choice, usually unconsciously. They choose status over wealth. They choose fitting in over building capital. They choose the approval of their peer group over their own financial security. And by the time they realize the trade they've made, it's often too late to undo it. Munger's solution was radical: stop caring what your peer group thinks. Not in a rebellious teenager way, but in a rational adult way. Decide what actually matters to you and optimize for that, regardless of how it looks to others. If that means driving an old car while your colleagues drive new ones, fine. If that means living in a modest house while your peers live in mansions, fine. If that means skipping the expensive dinners and vacations, fine. But most smart people can't do this. Their need for validation is too strong. They've spent their whole lives being rewarded for meeting other people's standards. The idea of setting their own standards and ignoring everyone else feels wrong, almost immoral. So they keep spending to maintain status, keep working to afford the spending, and keep wondering why they never build wealth despite their intelligence. The fifth trap is what Munger called the income illusion. Smart people tend to earn high incomes. Doctors, lawyers, engineers, executives, these are well-compensated professions. And high income creates a dangerous illusion. The belief that you're doing fine financially because you earn a lot. But income and wealth are completely different things. Income is what you earn. Wealth is what you keep. And many smart people earn enormous incomes, while building zero wealth because they spend everything they make, plus a little more. Munger saw this pattern everywhere. A surgeon making $500,000 a year with less in savings than a plumber making $60,000. The surgeon had the big house, the luxury cars, the private school tuition, the expensive vacations. He looked successful. But his net worth was almost zero. One bad year, a malpractice suit, a health issue, a divorce, and he'd be financially devastated. The plumber, meanwhile, lived in a modest house, drove a 10-year-old truck, sent his kids to public school, and took camping vacations. He looked ordinary. But he'd been saving 30% of his income for 20 years. His net worth was approaching $1 million. He had options the surgeon didn't have. The difference wasn't intelligence. The surgeon was clearly smarter in the academic sense. The difference was that the plumber understood something the surgeon didn't: a high income means nothing if you spend it all. The plumber treated his income as a tool for building wealth. The surgeon treated his income as a license to spend. This is where intelligence actually becomes a liability. Smart people convince themselves they deserve a certain lifestyle because they worked hard to get their education and career. They earned this. They sacrificed. They spent years in school while their friends were making money. Now it's their turn to enjoy the fruits of their labor. And this narrative is so compelling that they never question it. They never ask whether enjoying the fruits of their labor should mean spending everything they earn. They never consider that maybe the real fruits come from building capital, not consuming it. Munger believed that high-income professionals were often the most financially vulnerable people in society, not because they couldn't afford things, they could afford almost anything, but because they'd built lifestyles that required constant high income to maintain, and income, unlike wealth, can disappear overnight. A lawyer friend of Munger's learned this the hard way. The man made $400,000 a year at a top firm. He'd built a lifestyle around that income: $15,000 monthly mortgage, $2,000 car payments, private school tuition, country club dues, expensive everything. He wasn't saving much because he didn't feel like he needed to. The money kept coming. Why worry? Then the firm went through a restructuring. He was asked to leave. Suddenly, the $400,000 income was gone, and with it, his entire lifestyle collapsed. The house went on the market, the cars were sold, the kids had to transfer schools. His wife, who'd built her social life around the country club, was devastated. Within a year, they'd burned through what little savings they had just trying to maintain their lifestyle while he looked for a new position. By the time he found another job, they were essentially starting over financially. 20 years of high income, and he had nothing to show for it because he'd spent it all maintaining status. The cruel irony, Munger noted, is that smart people often think they're too smart to let this happen to them. They think financial problems are for other people, the irresponsible ones, the unlucky ones, the ones who didn't plan ahead. They have advanced degrees. They earn six figures. They read the Wall Street Journal. Surely they're doing fine. But income creates comfort, and comfort creates complacency. When you're earning well, It's easy to tell yourself you'll start saving more next year. There's always next year. The money keeps coming, until it doesn't. Munger's advice to high-income professionals was simple and mostly ignored. Pretend you earn half what you actually do. Bank the other half before you see it. Live on less than you make, regardless of how much you make. Because the goal isn't to maximize your lifestyle. It's to maximize your freedom. And freedom comes from wealth, not income. The sixth reason smart people stay broke is that they use sophistication to camouflage bad decisions. This is perhaps the most uniquely intellectual trap, and Munger considered it one of the most destructive. Smart people are excellent at building narratives that justify their choices. They can take a fundamentally stupid financial decision and wrap it in such sophisticated reasoning that it sounds brilliant. They use technical terms, cite research, reference theories. By the time they're done explaining, the bad decision sounds like genius. Munger watched a colleague do this with a vacation property. The man bought an expensive second home he couldn't really afford. But he didn't frame it as "I wanted a beach house, so I bought one." He framed it as a strategic investment in a growing real estate market with significant tax advantages and potential rental income. He'd done a full analysis. He had spreadsheets showing how the rental income would cover most of the mortgage. He'd researched appreciation rates in the area. He'd calculated the tax deductions. On paper, it looked like a smart investment decision, not an emotional purchase. 5 years later, the house was a money pit. The rental income never materialized because he and his family wanted to use it on weekends. The maintenance was higher than projected. The market didn't appreciate as expected, and the tax benefits were negligible because of the mortgage interest. But here's what made it particularly problematic. He'd told everyone about his sophisticated analysis. He'd explained his reasoning to friends, family, colleagues. He'd positioned himself as someone who understood real estate investing. So when the investment failed, he couldn't admit it. That would mean admitting his analysis was wrong, which would mean admitting he wasn't as smart as he'd presented himself. So instead, he doubled down. He created more sophisticated explanations for why the house was still a good investment, just on a longer timeline. He reframed the losses as temporary market fluctuations. He found new research to support his decision. He built ever more complex models showing how it would eventually work out. This is what Munger meant by using sophistication as camouflage. The intelligence doesn't help you make better decisions. It helps you defend worse ones. You're so good at building rational-sounding arguments that you can convince yourself of almost anything. The less intelligent investor who bought a vacation home would at least be honest about it. "I wanted a beach house. It's expensive, but I enjoy it." They wouldn't pretend it was an investment. They wouldn't build elaborate justifications. They'd just admit they bought something they wanted and accept the financial cost. The smart person can't do this. They need their decision to be rational, not emotional. They need to believe they're making smart choices, not indulging desires. So they construct elaborate intellectual frameworks that let them spend money while feeling smart about it. Munger saw this with every type of purchase. Cars weren't just cars, they were investments in reliable transportation with strong resale value. Clothes weren't just clothes, they were necessary professional expenses that generated ROI through career advancement. Expensive dinners weren't just expensive dinners, they were networking opportunities with strategic value. The language of sophistication made it impossible to have an honest conversation about spending. You couldn't tell someone they were wasting money because they'd buried the waste under layers of sophisticated reasoning, and they'd defend those reasons with the full force of their intelligence. This is why Munger believed that sometimes being less articulate would be a financial advantage. If you can't construct elaborate justifications for your choices, you're forced to be more honest about what you're actually doing. You're buying something because you want it, not because you've convinced yourself it's a smart investment. The really dangerous part is that smart people eventually start believing their own sophisticated narratives. It starts as rationalization. You know you want something, so you build an argument for why it's actually smart to buy it. But over time, the argument becomes your reality. You genuinely believe you're making rational decisions, even when you're just indulging in sophisticated self-deception. Munger's antidote was brutal simplicity. When evaluating a financial decision, strip away all the sophisticated language. Don't ask, "What's the strategic value?" Ask, am I spending money I don't have on something I don't need? If the answer is yes, it's a bad decision, no matter how smart you can make it sound. The seventh trap is opportunity cost blindness, and this one particularly fascinated Munger because it showed how intelligence could actually work against you. Smart people understand the concept of opportunity cost intellectually. Every economics student learns it, but they almost never apply it to their own financial decisions. Opportunity cost is simple. When you spend money on one thing, you're choosing not to spend it on something else. Every dollar spent is a dollar not invested. Every purchase is a trade-off. But smart people somehow forget this when making real decisions about their own money. Munger watched a lawyer friend buy a $90,000 car. The man could afford it in the sense that his income covered the payment. But Munger did a different calculation. That $90,000, if invested at a conservative 8% for the 30 years until the man retired, would become $900,000. The car didn't cost $90,000, it cost $1 million in retirement wealth. When Munger pointed this out, the lawyer dismissed it. You can't think that way about every purchase, he said. You'd never enjoy anything. And technically, he was right. But he was also on track to reach retirement age with almost nothing saved while driving a series of luxury cars he couldn't remember. This is the blindness Munger identified. Smart people understand compound interest when they're thinking about investing. They understand that money grows over time. They get the math, but they don't connect that understanding to their spending decisions. They see their income as available for spending, not as potential capital that could compound. The opportunity cost isn't just in big purchases, though those are the most dramatic. It's in the accumulation of small ones. The $200 dinners that could have been $50 dinners. The $10,000 vacations that could have been $3,000 vacations. The $5 daily coffee that could have been $1 coffee made at home. Individually, none of these matter, but over a lifetime they represent hundreds of thousands or even millions in lost compounding. And smart people never see this because they're focused on whether they can afford each individual purchase, not on the cumulative opportunity cost. Munger believed this was a failure of imagination. Smart people can imagine complex scenarios in their professional lives. They can project trends, model outcomes, think decades ahead. But when it comes to their own spending, they can't imagine their future selves. They can't feel the reality of being 65 years old with insufficient retirement savings. That future person feels abstract, distant, not quite real, so they optimize for their present self. Present self wants the nice car, the good wine, the comfortable lifestyle. Future self will figure it out somehow. And this is how brilliant people reach retirement age with nothing, wondering where all the money went. The tragedy is that the information gap isn't the problem. Every smart person has read about compound interest. Most have read the studies about savings rates and retirement security. They know intellectually what they should do. But knowing doesn't translate to doing because the emotional pull of present consumption is stronger than the abstract promise of future wealth. Munger's solution was to make the opportunity cost visible and immediate. When considering a purchase, he'd calculate not just the price but the foregone compound value. That $50,000 car didn't cost $50,000. It cost whatever that money would have become over time. And suddenly, the trade-off became real, not abstract. But most smart people won't do this because they don't want to know. They don't want to confront the real cost of their choices. They want to believe they can have both, the nice lifestyle now and the secure retirement later. And their intelligence helps them maintain this delusion by building sophisticated arguments for why their spending is necessary, reasonable, justified. The smarter you are, the better you are at fooling yourself. And nowhere is this more true than in failing to see what you're giving up every time you spend instead of save. The eighth trap is what Munger called the learning curve illusion. Smart people believe that with enough study, they can master anything including money. And to be fair, they usually can master the concepts. The problem is that financial success isn't about mastering concepts. It's about managing behavior over decades. And behavior doesn't have a learning curve. It has a consistency requirement. Munger watched countless smart people approach money like a subject to be studied. They'd read books, take courses, follow markets, absorb information. They'd learn about asset allocation, diversification, tax optimization, estate planning. They'd become remarkably knowledgeable about finance. And then they'd do nothing with the knowledge. Or worse, they'd use the knowledge to make things more complicated than they needed to be. The issue is that being good with money is mostly about doing simple things consistently for a very long time. Save regularly. Spend less than you earn. Don't panic during downturns. Don't get greedy during booms. That's basically it. A 10-year-old could understand these principles. But smart people can't accept that the solution is this simple. They keep studying, looking for the advanced techniques, the sophisticated strategies, the secrets that will give them an edge. They want to believe that their intelligence provides an advantage, so they search for ways to apply it. This is how they end up with complex portfolios they don't need, tax strategies that barely help, and investment approaches that sound impressive but underperform simple index funds. They've confused knowledge with wisdom, information with results. Munger compared it to physical fitness. Everyone knows how to get fit, eat less, move more, be consistent for years. There's no secret. There's no advanced technique that replaces the basics. But people keep looking for shortcuts, hacks, sophisticated programs, because the simple truth is boring and hard. Money is the same. The solution is boring and hard. But smart people want it to be interesting and easy. So they study more, hoping to find some insight that will let them skip the boring hard part. They never find it because it doesn't exist. A Professor Munger knew exemplified this perfectly. The man taught economics. He understood markets better than 99% of people. He could explain efficient market theory, behavioral finance, portfolio optimization, all of it. His students thought he must be wealthy because he was so knowledgeable. He wasn't. He understood everything about finance, except the most important part, actually doing it. He spent so much time learning and analyzing that he never built the simple habit of saving regularly and investing consistently. He always felt like he needed one more piece of information before he could start. One more book, one more course, one more market insight. 20 years of learning, and he'd accumulated almost no wealth because learning isn't doing. Knowledge doesn't compound, only capital compounds. And capital requires action, not understanding. This is why Munger believed that a mediocre plan executed consistently beats a brilliant plan executed sporadically. Smart people often have brilliant plans. What they don't have is consistency. They get bored with the basics. They want to move on to advanced topics. They want intellectual stimulation, not routine. But wealth building is routine. It's the same actions, repeated month after month, year after year, decade after decade. It's boring. And that's exactly why most smart people fail at it. They can't tolerate the boredom. Munger's approach was to accept the boredom and find intellectual stimulation elsewhere. He didn't need his financial strategy to be interesting. He needed it to work. So he kept it simple, automated what he could, and focused his intelligence on other problems. His money was boring by design, and it compounded for 70 years while his brilliant colleagues were still looking for the sophisticated strategy that would let them skip the boring part. The learning curve illusion is particularly cruel, because it makes smart people feel productive while they're actually procrastinating. They're learning, reading, studying. That must mean they're making progress, right? But financial progress isn't measured in knowledge gained. It's measured in wealth accumulated. And by that metric, all their learning is worthless until they actually start doing the boring thing they already know they should do. So here's what Munger concluded after watching smart people fail financially for nearly a century. Intelligence is an advantage in life, but not with money. With money, intelligence is often a handicap that must be overcome. The solution isn't to become less intelligent. The solution is to recognize that building wealth doesn't reward intelligence. It rewards discipline, consistency, and humility. And smart people are often terrible at all three because their intelligence has protected them from needing to develop those traits. If you're smart and broke or smart and not as wealthy as you should be, given your income and education, here's what you need to accept. The problem isn't that you don't understand money. You probably understand it better than most. The problem is that your intelligence is getting in your way. You're overthinking simple decisions. You're using sophistication to justify bad choices. You're pursuing complexity when simplicity would serve you better. You're analyzing when you should be acting. You're studying when you should be saving. You're learning when you should be doing. Munger's advice to smart people was this: dumb down your financial strategy until it's simple enough that you'll actually follow it. Not simple because you're stupid. Simple because simplicity works and complexity doesn't. That means automated savings that leave your account before you see the money. That means index funds instead of stock picking. That means living below your means regardless of how much you make. That means ignoring your peer group's spending patterns. That means accepting that you'll look less successful than you actually are. It means treating your intelligence as irrelevant to your financial decisions. You're not going to think your way to wealth. You're going to bore your way to wealth through repeated, uninteresting, unglamorous actions taken consistently over decades. If you can't accept this, if you need your financial strategy to be sophisticated because you're sophisticated, if you need to feel smart about your money, then you'll probably stay broke despite your intelligence. Not because you don't understand compound interest or market dynamics or tax law, but because you can't overcome the psychological traps that your intelligence creates. The smartest thing a smart person can do with money is recognize that being smart doesn't help here, that the game doesn't reward intelligence, that all your education and analysis and sophisticated thinking are actually working against you if they prevent you from doing the boring, simple, obvious things that actually build wealth. Munger lived to 99. He watched empires rise and fall, markets crash and recover, trends come and go, and through it all, one pattern held constant: smart people staying broke while pretending they were about to figure it out. Always one more book away from understanding, always one more strategy away from success, never quite willing to accept that the answer was simple and boring and beneath their intelligence. Don't be one of those people. You're smart enough to understand the problem. The question is whether you're wise enough to do something about it. The choice is yours. But the clock is ticking. And every year you spend being clever is a year you're not spending building wealth. Intelligence can't save you from that. Only discipline can.